Take a look at the sheer volume of discarded paper and debris covering this room. The public stock market is inherently volatile, a place where fortunes hinge on shifting public sentiment and split-second decisions. Despite that volatility, tapping into the market remains the ultimate goal for a growing private company. To raise the massive amounts of capital needed for long-term expansion, a company will initiate an initial public offering, or IPO. An IPO is the process where a private corporation offers shares to the public for the first time. But this transition presents a massive problem. Issuing millions of shares directly to an unpredictable public is a financial gamble. If buyer demand suddenly drops on opening day, the company risks raising nothing and failing spectacularly on a public stage. To avoid that disaster, an intermediary steps into the vacuum to absorb the risk. This entity is the underwriter, typically a highly capitalized major investment bank. The underwriter provides a guarantee through what is called a firm commitment. A firm commitment is a financial agreement where the underwriter agrees to buy the company's entire inventory of newly issued stock up front at a set price. By executing this transfer, the private company receives its guaranteed capital immediately, completely insulated from market swings. The risk hasn't disappeared, it has simply shifted. The underwriter is now completely holding the bag. The remainder of the IPO process becomes a high-stakes race for the underwriter to engineer market demand and sell off those shares before they lose their own investment. But before the underwriter can sell a single share to recoup their money, they have to face the federal government. Specifically, they must answer to the U.S. Securities and Exchange Commission, or SEC, the agency responsible for protecting investors. The underwriter and the company must file a Form S-1 registration statement. This is a mandatory document outlining the exact details of the company's business model, how they plan to use the capital, and a full audit of their legal health. Submitting this form triggers a critical regulatory phase known as the cooling-off period. This cooling-off period is a mandatory pause. Regulators use this time to investigate the filing to ensure all material information about the IPO has been disclosed to the public. For the underwriter, this creates immense financial tension. Their massive capital investment is entirely locked up and at risk while regulators take their time scrutinizing the paperwork. While this regulatory hurdle guarantees market transparency, it forces the underwriter into a holding pattern. Every day spent waiting increases the pressure to secure buyers the moment the regulatory pause ends. Once the SEC finally clears the filing, the starting gun fires. The underwriter must urgently find institutional buyers to offload their massive stock inventory. To do this, they launch the Roadshow. This is a high-speed, nationwide tour where bankers fly on a sleek private jet to pitch the prospectus to elite institutional investors. A prospectus is the formal document detailing the investment offering. These conferences serve a dual purpose. While the bankers pitch the stock, they are also conducting active reconnaissance to gauge actual, real-world investor excitement. This data visualization shows how the orders received during the roadshow dictate the exact final IPO price. The bank takes these scattered, variable investor bids and mathematically calculates the price point needed to guarantee demand. To handle this volume, the lead underwriter forms a syndicate, partner banks brought in to allocate shares, distributing these freshly priced stock clusters outward to spread the remaining financial risk. The roadshow and the syndicate allocation are the critical mechanisms of the IPO. Together, they convert a risky guess into a mathematically precise sell-off, neutralizing the underwriter's initial gamble. All of this highly calculated effort culminates in opening day. The opening bell rings, cameras flash, and massive crowds of the general public flood the financial district to celebrate the new listing. There is a major misconception about this moment. It is only at this final, highly publicized stage that the general investing public can actually log into their brokerage accounts and purchase the stock. While retail investors are rushing to buy, the underwriter is experiencing deep relief. By the time the opening bell rings, the underwriter has already successfully offloaded their massive, risky inventory to the institutions. Their job is effectively done. The underwriter acts as an invisible, highly calculated bridge, connecting private corporate ambition with massive public capital. Their success depends on three specific maneuvers: absorbing the initial financial shock, navigating strict transparency requirements, and building market demand. Without underwriters willing to risk their own capital on a firm commitment, private companies would face impossible odds going public. The modern stock market relies on this safety net to reliably function and fuel the growth of the global economy.